My name is Lana Jones. This is project number 2, business structure comparison and analysis. So with the sole proprietorship, it is one sole owner, not a separate entity. If you've ever seen Bob's Burgers, he's the sole proprietor. No formalities are needed, so when Bob started selling his burgers, he started the business. Hugh was always harassing him for the regulations and everything, so you have to have that to really keep the business going. Capitalization are operations funded by the sole proprietor, which is based off of their own financial wealth. And you can see here that Bob invested in a food truck, and he obviously was not able to invest in the nicest food truck. The sole proprietor has the authority of management and not subjected to the bureaucracy or delay of others. However, they don't have financial backup. So they're responsible for the hiring of the other people and their mess ups. Taxes by sole proprietor are taxed individually, and the tax advisor always uses the profits and losses to offset the income to earn them money back at the individual rate. The sole proprietor has unlimited liability, leaving them solely responsible for the debts and obligations of the business. So Bob is always trying to figure out with his landlord how he can extend the payment of the debts he owes. The owners act as the agent of the business, and the owner can hire any employee to act as the agent. Like his kids, he makes them act as the agent, advertising outside the store. And if the sole proprietorship decided to leave the company, it may discontinue at will. The owner is still responsible for the debts and obligations, but the company terminates upon death unless it's passed to the heirs, which Bob will probably do to his children. Next is the general partnership. It has 2 or more persons. It can be individuals, partnerships, corporations, or other associations. Like, for instance, a small law firm of 2 guys, the formalities of general partnership are recommended with a written partnership agreement. So for the small law firm to begin, a general partnership is easy. They can just really, clap hands and they've started. They're partners. The capitalization of a general partnership usually consists of the contributions, loans, and assets of the different partners. They can't sell shares of the stock to raise capital. So in the small law firm, the 2 partners, they have to contribute to the running of the company. In a general partnership, each partner has the authority to manage partnership affairs. Partners can act on behalf of each other, and this can cause complications. So they could vote for a managing partner, which would help with confliction. General partnerships are taxed similar to the, not similar. They use the net income and loss and then pass it through to the partners filing a partnership return. So no income tax to partnership itself. They're taxed individually, and it may make the partners have to pay more income tax than what they receive, which is not good. The partners of general partnership are, they have unlimited liability, making them liable for the debts and obligations and torts committed on behalf of the partnership. So if one of the partners of the small law firm were to suffer from a client not being able to pay, all the partners would be responsible for paying. A general partnership's agents of a small law firm have a fiduciary duty that binds them to the acts undertaken concerning the business. So this, too, could be frustrating. You might want to ask someone before you do something and supposedly benefit of the company. If a partner decides to leave the company because they've just had enough, it dissolves immediately. If death occurs, the shares should be passed to the remaining partners and financial interests passed to the heirs, unless it otherwise states in the partnership agreement. So it's pretty easy to end that. The next thing is the limited liability partnership. It's much like a limited partnership. It needs 2 or more persons to operate. The formation of an LLP is basically a general partnership with added limited liability. You must file a statement of qualification with the Secretary of State. A limited liability partnership has an advantage of capitalization by being able to attract investors that accept no personal liabilities. So if a limited liability partnership attracted strategic advisors that wanted to invest in the law firm, they would have no liability concerning the debts of the agency. The partners of an LLP have an equal right to management, but if they want the limited personal liability, they cannot participate in management. So, for instance, one of the law firms elects a managing partner so they can keep their limited liability. The taxes of a limited liability partnership flow through to the partnership separately in the informational return filed on behalf of the partnership. Each and every partner of a limited liability partnership is protected from a personal liability. If protected by a partial shield, they are protected from other partners' wrongdoing, and if protected by the full shield, they're protected by everything unless they do it themselves. In an LLP, so that they're protected by the full, they'll elect a managing partner. That partner is then the agent of the company and the partners. A general partner of the company would be an agent as well as an agent for the company. So, for instance, the three partners of a LLP law firm elected one of the partners as a managing partner. That would be their agent and the company's agent. So, limited liability partnerships are dissolved indefinitely. They may dissolve on death or withdrawal of a partner unless stated differently in a partnership agreement. The interests are difficult to transfer, so a statement of cancellation must be filed with the Secretary of State. So next is the LP limited partnership. May have one or more general partners. So, for instance, two brothers start a landscaping company. They can be either a natural person, a partnership, an LP, a trust, a state, or association, or corporation. But in this instance, it was just two persons. So because they have to have one or more limited partners, they had an uncle or a godfather that invested as a limited partner. To form the partnership, the two brothers and the uncle had to, or the godfather had to file articles of limited partnerships with the Secretary of State. And besides their godfather's investment, or the partner's investment, the LP has the ability to raise cash by attracting investors. For instance, the two boys attracted an investor that provided them with tractors to promote the sale of those type tractors. Both of the brothers have an equal share of management because they're general partners. The limited partners have no say in the management of the company. So say the two boys voted or placed a thing in the magazine to advertise, and the partners or in the investors did not have any say of that. The limited partners have an advantage in taxes. They are not taxed as a separate entity, which pass tax profits and losses directly to the limited partners without them risking more than what they've invested. It's a flow-through entity that pays no taxation on income. The limited partners, like the uncle or the tractor company, have limited liability protecting them. So if anything happens with the general partners or the two brothers, it's their full responsibility to pay the debts or, the obligations. Like if this tractor breaks, it's their obligation to fix it. In an LP, a general partnership, the general partners act as the agents of the company, and the limited partners place their trust in the general partners to handle all of their business matters. So here you see the limited partner doing a trust fall to the two landscaping brothers. The LP is indefinite. It may dissolve on death or withdrawal of a general partner unless otherwise a partnership agreement states. So if one of the brothers decides to leave, the partnership may be dissolved unless the partners or whoever decide within 90 days to continue the business. The next thing is an LLC. It's owned by members and have few restrictions on the number of types of owners, the number or types of owners. So you can have one or more. And an example is Blockbuster. The formation, you have to have articles of organization filed with the Secretary of State, and it can include corporations, partnerships, trusts, and other entities. Membership interests in an LLC offer maximum flexibility to investors, and this helps on the capital because Blockbuster started in America and spread throughout the world. The management of an LLC is that all members are free to contribute without fear of losing the limited liability status. So all of the Blockbuster members can hold meetings and contribute to the management by voting. Owners and members of an LLC are taxed individually in the informational return filed on behalf of the LLC. If owned singly, the LLC is taxed as a sole proprietor and the income flows through to the owners and added to the personal income. Limited liability for all owners of an LLC are not held accountable for the debts or obligations or the other members' poor decisions. Having this liability does not protect them from the corporate veil, from piercing the corporate veil. So you can't have that one person acting out. It'll ruin the whole thing, like that man in Jurassic Park. Or maybe even Blockbuster. If there's no designated manager, the members are considered the agents of the company. Blockbuster didn't have a designated manager. They didn't have just one, so the members acted as the agents and grew the company until the company was not set on the right path and eventually had to close. And then there may be several restrictions closing an LLC, or at least on the transfer of ownership, but the business is perpetual in most states. A member that disassociates themselves has a right to their shares to have them bought out. But if dissolution occurs, the members are entitled to a final distribution, and then the distribution of assets is determined in the Articles of Organization. So just look in the company's or operating agreement. Next is the corporation. A corporation is a separate entity, an artificial person. It's completely separate from the owners or the shareholders. So for instance, this is Johnson & Johnson. They're a great corporation. The formation can be quite overwhelming. It has complex and numerous formalities. Articles of incorporation must be filed at the Secretary of State. And then meetings with the directors and shareholders are formed that cost money, and then the reports are often required. It's just a lot of work to keep up with. The corporations have increased potential for capital gain. The potential of dividends and stock appreciation, as well as limited liability, attract many investors. For instance, like a celebrity invests money in Johnson & Johnson so they can have a commercial or a name put on a bottle, and that promotes their fame as well as Johnson & Johnson. The shareholders of a corporation elect board of directors to oversee management. This is how the shareholders participate in a type of management. But when they elect the directors, they are how it is managed. The corporation is responsible for the tax on corporate income. This might get complicated. The shareholders are responsible for the income tax for income and dividends received. So, double taxation occurs if the corporations pay the dividends to the shareholders. For example, Johnson & Johnson pays shareholders a profit or a surplus of 1 year, and then pays taxes on the corporation's earnings. So they're paying taxes for the profit and surplus given and the corporation's earnings that are paid to the shareholders. So that profit received to use on their tax return is double taxation. Limited liability is offered to the corporations, shareholders, directors, and officers, leaving the corporate responsible for debt and obligations. But again, piercing the veil can leave everyone liable. Limited liability is a good thing. The officers and agents of a corporation of Johnson & Johnson act as the agents of the corporation. So here you see one of the agents giving a speech on behalf of the corporation. The duration of a corporation is perpetual. It does not dissolve upon death or withdrawal. Shares can be sold, given, or bequeathed. Transferring is easy. All you may need is just a signed document of transfer of stock. The deceased shares are passed to the heirs. For the end, I just did a little graph of the advantages and disadvantages of all the companies. Here, I just look at this as I would want more advantages than disadvantages. So I would probably go with these two at the end, starting a business. Thank you.